Advanced Financial Accounting Excel Practice Problem. In this presentation, we will work a practice problem in Excel related to a consolidation where we have a parent-subsidiary relationship, the parent owning less than 100% of the subsidiary. We will have a difference between the fair value and the book value of depreciable assets that we will be dealing with, as well as an intercompany transaction. And we're going to be doing this in year 5, the consolidation, in other words, taking place 5 years later, 5 years after the original purchase, resulting in the controlling interest and need for consolidation. And therefore, we'll have to be dealing with any changes that will result from that, including, say, accumulated depreciation that will be resulting from that since the point of consolidation or since the point of purchase within the consolidation taking place in year 5. Get ready to account with Advanced Financial Accounting. Get ready to account with Advanced Financial Accounting. Here we are in our Excel worksheet. We have the information on the left-hand side. We're going to enter that into the blue area down below and to the right. We'll have our entries that we will be entering. We have the information for Company P, Company S, parent subsidiary, and we're going to be entering that into our consolidation worksheet. Let's go back to the data on the left where we have P purchased a percent of S on January 1st, 2000 X0, that percent being 80%. Now, note that this happened 2000 X0, the point in time that we will be doing the consolidation. One of the key differential factors for this problem will be 2000. So note we have 5 years there. We got X0, the full year for 2000 X0, January through December, and then 4 more years. So we're actually talking 5 years total. We'll have to be dealing with the accumulated depreciation involved in that, as well as any other factor that could be involved within it. So then we have the amount paid, $150,000 at that point in time. Fair value of the non-controlling interest, $37,500. S equity section included, retained earnings, and the common stock. In other words, they're giving us the equity section at the point in time the purchase happens. Why? Because we can't get the equity section if we're talking about a practice problem that's 4. Note that it should be 5 years out. So if I refer to 4 years out, just remember it's going to be 5 years out since the point in time of purchase. 4 years out. The 4 years out is designed not for us to recalculate this number or figure out the equity section, but to consider those 4-year time periods and the effect on it with things like accumulated depreciation. So in practice, of course, we would get that information from the financial statements at the point in time of purchase. Here, they're going to have to give it in a problem such as this. Fair value of depreciation asset higher than the book value. In other words, at the point in times of purchase, if we were to take a look at S's depreciable assets, which would be the book value, the cost minus the accumulated depreciation at the point in time of purchase, it was higher. The fair value was higher. We determined it to be higher by the 47.5. That's going to be the key factor because we know that if we increase that amount, we'll also have to deal with the depreciation and the related accumulated depreciation, which will be accumulating now for the point in time of this consolidation or of the purchase. Then we have the intercompany receivables of 12,000 So there's the receivables on the book, let's say on P's book from S, and on S's book they have a payable to P. And so we'll deal with that. We've seen that in the past, so nothing real new. It's just another, complication, another thing that we got to deal with for this practice problem. All right, then we have our information down below. This is going to be starting off with the book value calculation. So that's always what we want to think about. Now, note, if I go back over to our worksheet over here, we want to think about as much as we can how this number was created and how this number was created. So to do that, we'll reconstruct whether goodwill was involved in it, and then we'll reconstruct the equity section, at least for the current time period, to give us an idea of that. So that's where I typically will start. So we're going to say, all right, then the book value, they had to give us the book value at the point in time the purchase took place. And we're going to say that it's actually the sum of these two, the equity. So they give us the equity, which is assets minus liabilities equals the equity section, the 140. Then the fair value of the depreciable assets is going to be higher by this 47,500. Then we're going to sum those two up. That will give us then the fair value total. Then we have the non-controlling interest. You would think maybe I would take 80%, but if given the non-controlling interest, that's what we're going to say. We're going to say of that total, we're going to say the fair value of the non-controlling interest was 37.5. Therefore, the controlling interest is that 187.5 minus the 37.5. And then compare that to the amount that was paid. If there were no goodwill and we purchased whatever the 80% was here, you would expect it to be $150,000. How much did we pay? If we paid more, there's goodwill. No, we paid exactly that $150,000. So no goodwill involved. That's nice. So we have that. So that's going to be our calculation. So we have to deal with its fair value difference, but not with a goodwill difference. Now let's think about the equity method. Now I'm not going to be posting this. We're just basically rethinking how this number came about, how these two numbers came about, this number and this number. Now I'm not going to do it since the point in time that we started, which was just for this year. What happened to the equity section this year? So we're going to say, all right, well, we know that there was an increase in the investment, let's say, and the other side is going to go to income. So this is what happened. I'm not going to post this. I'm reconstructing what happened in the current year. And you would think that that would be for our portion or P's portion, parent's portion of the net income. So the net income down below of the 40. And then I'm going to multiply that times our portion, which was 80%. So that times the 80%. There's the debit and the credit. Now that doesn't take into account the change that's going to take place due to the depreciation in the current year for the increased amount of the depreciable assets, 47.5. We'll take a look at that in a second. But then we have the dividends that went out. The dividends would be increasing cash for P, and the other side would then be going to decreasing the investment in S for the amount our portion or P's portion of the dividends, which is going to be the total dividends that went out here, 18 times our portion, which is the 80%. 80% of that. So there we have that. That's the normal kind of thing that would happen. Then we have our portion of the change, the new thing, the difference between the depreciation, because this depreciation is going to affect the income, and that's going to affect, our portion of this number. So we're going to account for that. It'll only happen not on S's books, but within the consolidation process. So for that, we're going to debit the income from S, decreasing that, the other side going into the investment. And then I'm going to calculate this, and we'll do this again when we do the elimination entry, so I'll do it fairly quickly here. We're going to say that was the increase. That's going to be the increase here, the 47.5 divided by the years we're going to depreciate it over, 10. That would give us the depreciation for the current year that we're talking about, times the 80% our portion of it. So notice what we didn't do is we didn't recalculate it for the other 3 years that have taken place, because we're just looking at the current year's activity. So there we have that. So there's the debit and the credit. So if we're going to take a look at the effect then on the investment account for just the current year, we have that 32, we've got the 14, we've got the 3.8. That does not match what's over here because that's only in the current year. If we look at the income account, but it's still useful, right? Because it'll give us an idea of what happens in general and what happened in the current year that we can deconstruct when doing the elimination entries. The income account is going to be the 32, and the 3.8, and that's going to be the 28.2, the 28.2, and that does match what is in the current account over here. So we can deconstruct that one as we do our elimination entries because those accounts need to go to 0. For now, let's hide this. So I'm going to go from D. I'm highlighting from D or selecting from D to G, letting go, right-clicking the selected area, and then hiding it. Okay, so now let's think about this. We're going to do our little worksheet over here. We've got P's books. We've got S's books. We're going to total them up for our consolidation, just as we've seen in the past. Just going to sum those two up. Going to hit Control-C, copying that. I'm going to hold down Shift and the down arrow. And then I'm going to paste that here and just paste it on down. And there we have that. So there's our starting point. We are focusing in on this account. So let's make that a different color. Let's make that yellow and red. Yellow and red there. And then we're going to make this account yellow and red because those need to go to 0 at the end of the day. Those are the two ones that we kind of looked at a bit. And we can deconstruct those and think about how this whole thing is going to be put together. All right. So now we're going to do our similar just standard process. I typically think about this account going down first just because that's the first one that I look at. And what we're doing is we're going to remove basically the equity section for S. This income statement and then the other side of of that. And then we'll think about the change in the building account. Then we'll think about, prior year activity that's a result of that and current year activity. So it'll be great. Similar process we've seen in the past, though. And again, you could break this up in different kind of journal entries. This is what makes sense to me. So, work it different ways, mix and match this thing up and deconstruct it and see what makes sense to you. So we're going to say, we're going to bring up the investment. I'm not going to put anything into it yet because I like to think of that as kind of like the plug, even though we will calculate it at the end. Then I'm going to remove the common stock. So I'm going to do the same process. I'll do it a little bit faster because we have seen this. This is the same process. I'm going to copy this, paste it there. And then we're going to say, here's the common stock is at the 95. So I'm going to debit it to remove it. So I'm taking away S's common stock. I'm going to do the same for the retained earnings. So it's a credit here. So I'm going to debit it to remove it. And then we have the dividends, which is a debit on this side. So a credit in our journal entry. So we're going to credit the 18. So those will be removed. So that's going to basically take these out. So that's going to be the equity portion there. Then we're thinking about the equity portion or the net income, basically, which is going to be that 40,000. So the 40,400, which is reflected here in the income from S, or at least their portion of it. So I'm going to remove this account. However, it's not going to tie out exactly even our portion of it because of the depreciation. So what I'm going to do is take that 40% times our P's portion. I think of ourselves as P. We're the parent. So we're going to go over here and say that we have the income. We need to reduce that. So that's going to be a debit. So I'm going to say negative of. I'm going to pick up the total income down below times our portion of it. Our portion of it being the 80%. So our portion being the 80%. Now I'm going to take a look at the non-controlling interest of the income, which is going to be the other portion, right? The non-controlling interest of the income, because we picked up our 80%, that's going to be the 20%. So this is going to be the other side of that. So I'm going to say, all right, this is going to be negative of that 40 times, and I'm going to do it this way. I could say 20%, but I'm going to say brackets 1 minus, and then I'm going to pick up 80%. So that's going to be the 20%. And then, of course, that 32 and the 8 add up to the 40,000, which is the total income. So now I'm going to think about so notice what we did here. We basically took the equity section, and we decreased it or debited the net equity. So that adds up to 202. So if I was to take like all of equity here, that would be the 202, right? So now we're going to record the other side, breaking that out between the two components, the majority and the non-controlling interest. So in other words, assets minus liabilities is the 202 as well. So the majority interest is going to go into the investment because it's been included here using the equity method, and the other side is going to go into the non-controlling interest. So I'm going to say, all right, non-controlling interest. Let's pick that up. And I'm going to do this by the full calculation. Again, I could take like the sum of this times 20%, but I like to pick it up from here so you could see it. So you could say the sum of this times 20%, 202, or the sum of this, which is going to be the 202 as well, times the 20%, or you could take the sum of this, right? 202 times 20%. All right, so I'm going to say that I'm going to be picking up the negative sum of assets minus liabilities, which will be the net assets. To me, that's the most direct way to see this, times, and I'm going to say 1 minus the 80%, which is 20%, and that'll be the 40,400. And then up top, you can think about this as the plug, right? You can think about this as the plug up top that you'll need, which is going to be the 161, or you could recalculate it, right? This is that whole thing times 20%. Now this is going to be the 80%. So the 80% interest, in other words, I could take this times 80%, or the same thing, 80%. So I'm going to say, all right, let's do the negative sum of the same thing. What happened? Negative sum of the same thing. And assets minus liabilities, brackets times the 80%. And there we have that. So that should put us in balance then. So there we have it. So there it is. Let's post it out. So let's post it out. So I'm going to go to the investment. So we're in the investment here in P9 equals, scrolling over to that 161.6. There we have that. Not down to 0 where we want it, but that's close enough. It's not down to 0 because we haven't accounted for, the effect on the changes and the net and the income that's happened over the last 4 years, that whatever. So now we're going to go into the common stock. We're going to remove S's portion, which brings us back to P's portion. We're going to do the same for the retained earnings. We're going to remove S's portion, which brings us back to P's portion. We're going to do the same for the dividends. We're going to remove S's portion. That brings us back to P's portion. So in other words, here's P's portion, here's S, here's the total of them. We basically simply removed S. We're back to where we were at the start with P. All right, then we're going to go to the income from S, which we would like to go to 0, but it's not yet because we didn't account for the change in the depreciation, basically the current effect on the income statement from the change that's going to happen to the fair market value versus the book value at the point 4 years ago of the consolidation. So that leaves us with 8.3. That's fine. And then we've got the net income. So that we're going to be putting the non-controlling interest down below. So non-controlling interest down here. And then we've got the non-controlling interest on the net asset side of things, basically in the equity section. So non-controlling interest here, which is going to be that 40,400. All right, that should put us in balance. So that looks good. All right, now what we want to do is think about the change that's going to happen to the balance sheet originally 4 years ago at the point in time of purchase, because we have to do this every time because neither P nor S will record this. So I'm going to say, all right, there was an increase into the building and the machinery. It went up by 47.5. So I'm going to say it's going to go up by this 47.5, which was here. And then we're going to say that, and again, you could now think, of the accumulated depreciation over the few years, but maybe it's easier to just say, hey, look, that machinery went up. Now let's think about basically the other side of that, which we're going to break out between the investment account. I'm thinking about the two balance sheet accounts that are related to this. So the controlling interest will go into the investment account, the non-controlling interest in the non-controlling interest account in an 80-20 split. So negative of this times 80% is going to go into the investment. That's included in the investment account in the equity method. I could do the negative sum of this whole thing, or negative of that times brackets 1 minus, and then I'm going to pick up this 80%. So that's going to be the change to the asset. There's no goodwill that we have to deal with, so there's not that issue, but there will be accumulated depreciation for prior years and current years. So let's record this. I'm going to say, all right, so then the building and the machinery, that needs to go up by the 47.5. The other side of that is going to be included in the investment in S due to the equity method, F2 plus F2. And then the other side is going to have to go into this new account that we made, which is the non-controlling interest in net assets of S. So F2 plus F2, and that's going to be the 9,500 there. So there we have that. Okay, so now this happened 4 years ago. We know that 47,000 needs to be depreciated now. The last 3 years of depreciation before the current year that we're in right now will not be affecting the income statement because it's already rolled into equity, right? So we got to then break out 3 years of depreciation between balance sheet accounts, which will be these same two accounts, and 1 year depreciation will have an adjustment we'll make in the current year, which is basically affecting the income statement. So let's do the 3 years first that have depreciated before the current year and just think about balance sheet accounts for them. That's how I would think about this. So I'd say, all right, well, now I know that accumulated depreciation is going to go up. I know it goes up with a credit, but I'm going to put it on top because that's the first account I would think about calculating. So I'm going to say, I'm just going to put that on top. And I'm going to say this is going to be a credit. And what I'm going to do is I'm going to say, all right, the calculation is going to be the added value here for 47.5 divided by 10. That would be depreciation per year. And it's been 4 years now. So I'm going to take that times 4. Why has it been 4 years? Because it happened in January X0, and now it's X4. Actually, it's so that's right. We're gonna take that times 4 years. So it's been 4 years, and if I've misquoted that a couple times, that if I said 4 years total, it's 5 years total because X0 is counted, and then we're saying it was December X4. So it's been 5 years total. We're accounting for 4 of them here before the current year. All right, so there's the accumulated depreciation. We're then going to break that out to the balance sheet side of things. They're not going to be affecting the income statement, which will be broken out then by the investment in S, and the other side then go into the non-controlling interest. We're not affecting the income statement because they affected the income statement in the prior 4 years and then rolled over to the balance sheet, to the equity section. So then we're going to say 80% of that. I'm going to say negative of this number times 80% is going to be going to the investment. The other 20%, which I could do a negative sum formula here, or I could take negative of that number times brackets and then pick up 1 minus that 80%, 1 minus the 80%. And that should be the difference as well, so that those two should add up to that 19. So if I was to highlight those, they add up to the 19. Let's go ahead and post this out. So the accumulated depreciation then going up. So I'm going to be increasing the accumulated depreciation now of that 19,000. Notice we have to do this every time. We got to update the accumulated depreciation. And then we're going to have the investments every time we do a consolidation. The investment, recognizing that side, I'm going to say F2 plus F2, picking up the 15.2 there. So there's the 15.2. Other side going into the income in the non-controlling interest in net assets, F2 plus F2. And we're going to be picking up that 3,800. Okay, now let's think about the current year depreciation, because the current year depreciation, I'm going to record the total depreciation normal journal entry first, which would be depreciation expense, and then the other side going to accumulated depreciation. Then we'll think about the effect that will happen due to that change in the depreciation expense calculation to the breakout between non-controlling interest and the controlling interest, because now we changed the original calculation of the 40,000 that we've been basing some of our information on. Okay, so same thing. We're going to say, all right, the depreciation for the current year then is going to be that 47,000 just divided by 10. I'm not going to multiply times 80% because we're talking about the full thing this time. We're recording the full thing to the income statement. Depreciation then going up by that 4,750. Other side going to accumulated depreciation. So accumulated depreciation on P8. We're going to say F2 plus F2, and we'll pick up the other side of that. Okay, so there we have that now. And I think it's useful to kind of think about this down here too. This 40,000, if you think about the effect on just S, let's just do a reconciliation of S. We're going to say there was an adjustment to depreciation of this 4,750. So if we were just to think about S's net income after adjustments, S net income after the adjustment, we're going to say, all right, now it was 40,000 and we decreased it by that 4,007. If I break that out between P and S percentages, which of course would be the 80% up top, 80% here, and the 20%, which I'm just going to say is equal to 1 minus that 80%. And if we make those percentages, home tab and numbers, and I make that a percent, and if we multiply this out now I'm going to say, all right, well, this is going to be this times 80, and then this times 20. So you can kind of see the allocation there, that you would think then that this number, the non-controlling interest, would now be the new number we have, the amount we changed, 20% of that. So we're going to have to make some adjustments to this number and to the controlling interest. So let's go to the investment side of things, to the controlling interest first. So I'm going to say, all right, so the investment, we're going to pick up the investment account up top, investment in S, and the other side is going to be in the income from S. and I'm going to pick up that 4,750 times the 80%, times 80% for the controlling interest. And so there is that. So we're going to make that adjustment. And then I'll do the adjustment for the other side of that. So then I'm going to say, okay, the investment account then, going up to the investment in S, something's in it. And notice this should bring it down to 0 now. F2 plus F2, which is exciting. That's an exciting moment. So be excited, because this is going to bring it down to 0. So there's that. And then the other side is going to go to the income from S, which should bring it down to 0. Those yellow red ones that we've been highlighting are going down to 0, which is what we wanted. So that's good stuff. So there we have that. That brings us back down. Then we need to adjust this one to get to that 7,050 we would expect in the non-controlling interest. So that means that 8,000 has to go down. Let's put it on the bottom with a credit. And then the other side is going to go onto the balance sheet side of things, the non-controlling interest in the net assets. Same calculation except for the 20% now. 4,750 times, I'm going to do it this way, 1 minus the 80%. 1 minus the 80%, giving us the 20%. So 1 minus the 80%, giving us that 20% or the 950. Recording that out, let's see if it does indeed get us down to that 7,050, which is what we would expect here. So I'm going to say, all right, P's there, F2 plus F2. This is going to be the credit. So there we have that, and there it is. So that makes sense. That brings it down to what we would expect. And then we're going to go to the non-controlling interest up top in the net assets in P15, F2 plus F2. Scroll back down and pick up that non-controlling interest in the net assets. And that should put us back in balance. So obviously, you know, this one we can kind of reconcile. We could see that because that's what we need to be in balance here. And then this one we could double check basically with this calculation and verify that that number is correct. And that can be a, you know, kind of a double check on that one. Okay, so that's our main activities. Let's just remove the receivable payable difference here we had, because we said there was intercompany transaction. That means that the receivable here, we're going to say P was overstated on the receivables because a receivable is from S, and then there's a payable here on S's books that is going to P. So assets and liabilities, accounts receivable, accounts payable, both overstated. We'll remove the intercompany transaction. So we're going to say, all right, that's just going to be a debit to the accounts payable. And then I'm going to have a credit to the receivables for whatever that intercompany amount was, which must have been given to us in the data. In practice, we would see it on the subledgers for the accounts receivable and payable by customer and vendor, respectively. And so we're going to say that this is going to be that, here it is, intercompany receivables, 12,000. So there is that. There's the debit. There's the credit. Let's post this out. And we can basically wrap this up, hopefully. So I'm going to be here, say that we got the accounts payable is going to be going down by that 12,000. Recording the other side then to the receivable up top. This is going to be going down. I'm in P4 equals, scrolling down and picking that item up. So let's pick that item up in the receivable, that 12,000. And enter. So that should decrease it. So that then should put us back in balance here. We got our check figure here. These two amounts are down to 0. That makes sense. Equity section is now basically reflecting what was on P's books. So those are some of your major kind of check figures that you want to go through. Now, if you have problems with this, again, you want to deconstruct this compared to your equity section. I'm going to unhide the cells from B. I'm holding down from B to H. Let go, right click the selected area, unhide. It's a little bit more difficult to, like we say, deconstruct the investment, but this will give you an idea because there's more years involved. And then you could definitely deconstruct the income from S because you see how it came about this year. And so if that account isn't 0, you should be able to kind of back into it, comparing the equity method to your reversing entries.